Good evening, friends. This is Rahul Magan here as a Group Chief Executive Officer of Treasury Consulting and also a venture capitalist. Today, we are going to share a secret whereby the banks, without quoting the name, you need to guess the bank, right? Banks and the financial institution together with the joint hands with the big fours are doing something which is being strictly prohibited in the accounting standards. Yes, you're right. We are discussing about a topic which is known as how we can not misuse, how we can create the loophole in IFRS 9 whereby the reclassification adjustment can be an income to the bank. Let me give you a holistic case what is happening in the banking industry. From the last several days, I am reviewing the financial statements of the bank and I am being messed it up that boss what exactly they are doing and what they wanted to do. Now let me show you the holistic case in that regards. What happens that banks are having number of embedded derivatives in their books. There is no doubt about that. And these embedded derivatives are of two types. Number one, either they are directly with the client or they are in the interbank nature. Now, in the case of big banks like Goldman Sachs, Standard Chartered, UBS, Barclays and HSBC and all, it is on both sides. We need to appreciate that and it has to be, it should be, right? But apparently what is happening that IFRS 9 is a principle based approach while US GAAP is a rule based approach. But sometimes people got the leeways to find out the way in the principle based approach as well. And what is this leeway is that IFRS 9 to USP, unique selling propositions are reclassification adjustment, number one, and alternatively rebalancing of exposure. What happened that before moving further, let me give you a small glimpse exactly what these terms are all about. Now, reclassification adjustment means that first you do, basically for both you need to have a hedge accounting in place. And I don't think that I'm here to discuss, so basically just to cut the long discussion short, hedge accounting is nothing but it's a standard or the methodology whereby the mark to market of that relevant derivative will come in the OCI, other comprehensive income, then in the P&L. There are many companies in India and outside India, those who do not do mark to market accounting or hedge accounting, but that is a completely different, that is their jurisdiction, not ours, right? Now the question here is that what exactly it happens is that, and what is reclassification adjustment? Reclassification adjustment means that once you do the hedge accounting and assuming the hedge accounting pass, the gain and loss will go to OCI. From OCI, once it is mature, four ways: mature, cancel, rollover and maturity. I would repeat: mature, rollover, cancellation and pre-utilization. The unrealized component of the mark to market will come in the P&L. One is known as rebalancing exposure. This is pretty nice concept in the IFRS 9 and banks are misusing that to the larger extent. What is rebalancing of exposure? Which means that suppose today you dealt with the RIL, Reliance Justice Limited, book a $500 million deal with you. You did the hedge accounting. Now once you did the hedge accounting, we need to appreciate that, I hope you know that hedge accounting is not possible in case of fair value hedges. Now apparently speaking, the accounting standard does permit you to create three type of hedges only based upon exposure, technically four. One is the cash flow hedging, fair value hedging, net investment hedging and I hope you know that, freestanding hedging. I repeat, cash flow hedging, fair value hedging, net investment hedging and freestanding hedges. Now two, fair value hedging and freestanding hedges, they are outside the jurisdiction of the hedge accounting straight away. FASB, the custody body of US GAAP, Financial Accounting Standard Board, ISP, the custody body of IFRS, they both are having a common view that fair value hedge and freestanding hedges should be outside the jurisdiction of hedge accounting. Although I tend to differ on one part. According to me, that fair value hedges should be there, part and parcel of the hedge accounting, but anyways, I am not on the board of these forums, so I cannot answer. Let's come back to the main topic and discuss something which is pretty hot point, and soon there is a big fraud which is coming on the way. So what these banks do, suppose RIL take 500 million position from bank. Let me give you a fixed income case here. Or FX case, RIL do $1 billion of deal. RIL raised $1.5 billion. And in this $1.5 billion, 500 million they raised in INR and rest equivalent, and 0.5 billion they raised in INR and $1 billion they raised in USD. This bond is having an embedded derivative in place. There is no doubt about that. Now this embedded derivative, now RAL would cover this dollar exposure, of course, because they are getting dollar in India. That dollar exposure, RAL is a pretty smart company. RAL would be covering using CCS, cross currency swap, which is principal only swap plus coupon only swap. I don't think there is any doubt in the minds of the people. We have many videos in that regard. Now what a bank would do, being an embedded derivative, and we can have any type of embedded derivative in that. We can have a call contract, we can have a put contract, we have a ranged contract. There are a number of embedded derivatives which we have. Now one is quanto contract also. Soon we will talk about that. What exactly happens in this case is, once we have an embedded derivative, banks cover this the same way in the interbank market, assuming as this is just an assumption. Assuming RIL covered with HSBC and HSBC covered with Goldman Sachs, they are having an embedded derivative. How actually the scene happened? HSBC will show this as a level 3 trade. Because Big Fours are with them, they could create as a level 3 trade. What is level 3 trade? In a level 3 trade, level 3, actually this is known as principle of hierarchy, the valuation hierarchy in IFRS 9, also in US GAAP. So valuation hierarchy permits you to have 3 kind of valuation: level 1, level 2, level 3. Now in level 1 means mark to market, level 2 means mark to matrix, and level 3 means mark to model. In mark to model you will create a model, and whatever mark to market is coming, you need to put this in the PNL or the OCI provided hedge accounting holds true. Now who will control the hedge accounting? Is the Big Fours. They are doing that. Majority of the corporates and the banks don't have the leeway to manage the hedge accounting because they are dealing with several exposure. Now the scene is RAL issued a bond, HSBC helped them, right, as a co-arranger or an iBanker. It's being covered by GS, assuming in the interbank market. Now this embedded derivative initially is recorded as L3. And I don't know how many people are well versed with L3 methodology, not, but in L3, there are 2 variables actually in every 3, which is L1, L2 or L3. One is known as observable variable, one is known as non-observable variable. In case of L1, the observable variable is 100%. In case of L2, the observable variable is only 99%. In case of L3, the observable variable is 0. Now 2 questions before moving further. Who created the model? HSBC. Who vetted the model? Big Fours. Whose books are being impacted? HSBC. Who is getting the payment of the audit? Big Four. Open Google and see, tell me one fraud in which Big Fours are not involved. One fraud. The story starts here. Suppose this bond is of 5 years. If you have similar bond in L1, now it is the jurisdiction of the company to decide whether it is L1 or L3, and that has to be vetted by Big Fours. You know what Big Fours did in the last several years. If you have similar architecture at L1, you might end up in a loss, mark to market accounting loss, while if you are having similar architecture at L3, you might end up mark to market profit. Now that mark to market profit will go to the OCI. Okay. Now since that mark to market profit will go to OCI, how the banks are actually playing with IFRS 9 is that accounting standard does permit you that once the year end you can change from level 3 to level 2. What banks generally do, suppose if the periodicity is 5 years, after 3 years they will convert this from L3 to L2, the gain would continue, and under reclassification adjustment methodology, what they do, when the gain is at the higher side, because even L2, which is mark to matrix, you have few percentages as a non-observable variable, and who will decide the non-observable variables? Big Fours, no one else. Auditor and auditee, right? Who is auditor? Big Four. Who is auditee? The bank. Now the question is, once such kind of circumstances happen, banks would cancel the deal in the interbank market at a real cost, but in the books they book the imaginary cost. That imaginary profit immediately translate into the PNL, unrealized mark to market, which increase the EPS of the banks. EPS stands for earning per share, and I am talking about the diluted EPS, not the basic EPS, which does impact the bank's balance sheet, which does impact the the bonus of the CEO of the bank. The moral of the story is that the two simple USPs of IFRS 9, which is reclassification adjustment, and one is the rebalancing exposure. We had not yet discussed about the rebalancing exposure. We are going to discuss that. Would end up making substantial gains in the books of the banks and derivative, because they know how to use that loophole once the big fours are with them. What is rebalancing exposure? Suppose the RIL deal is $1.5 billion, and out of $1.5 billion, I already told you $500 million is in INR, rest $1 billion is the foreign currency funding. And assuming this is having the amortization schedule, RIL say we will pay $100 million every year, so that we don't want any burden on my head that after 10 years I need to pay you. Now every year this big four will force the HSBC to do the rebalancing of the exposure, because at the inception the exposure was 1 billion, now it is 900 million, next 100 will be 800, slowly it would be zero. How you will manipulate the rebalancing of exposure? It is pretty easy. Suppose you end up, although it generally don't happen because you are at L3, suppose you end up mark to market losses at L3. What do? You will transfer them into the rebalancing exposure. In nutshell, I will challenge you, you download the annual report of top 10 US banks in the globe and just see how many of them are giving you the complete table that this is the total mark to market L1, this is L2, this is L3, and this is the total, plus how many of you giving you a proper table that boss, this is the reclassification adjustment which comes in the credit side of P&L, this is the rebalancing exposure which comes in the credit side of P&L. End result, people don't have time to see the entire P&L. For several reasons, they don't understand that. They don't understand what is this L1, L2, L3, what is observable variable, what is non-observable variables. But just think carefully. HSBC is having several $1 trillion of derivative in the book. Goldman Sachs, Credit Suisse, UBS, Barclays, Standard Chartered, ANZ, Westpac, almost every one. If you are able to create a 1 cent, 1 bips of gain on the account of reclassification adjustment, how much money you can translate to the credit side of the P&L to maintain their bonus? I would like to cut short this video with only 2 questions. Is the reclassification adjustment right given by IFRS 9 is getting misused? Is the reclassification adjustment right is getting misused? Number 1. Do we have big fours who are supporting the banks? Examples are many. Third, is the rebalancing exposure is deliberately used extensively once you have the derivatives having embedded contracts? Question number 4, and very important last, and thank you very much. When was the last time we really looked at the annual report of the bank seriously and get to know where is the disclosure of embedded derivatives? Where is the disclosure L1, L2, L3 and the movement in between L1 to L2, L2 through L3, L3 to L1, L3 to L2? We not yet discussed that, because the moment once we started discussing going to take a lot of amount of time. IFRS 9 is a principle based approach, but unfortunately, without putting the name of the bank, we have few banks in the system, those who know how to use IFRS 9 in their own way. Of course, sooner or later, everything will come in the public domain. There is no doubt about that. Everything will come in the public domain. But the question is, by the time it will come in the public domain, we would have IMDb, we would have Highflex, we would have Noble Group, we might have a lot of scandals which this bank did. With this, if you are an auditor and your company is doing both reclassification adjustment and rebalancing of exposure, please have a holistic look. With this, Reggie Consulting, thank you very much. You know my mobile number 919899242978. You know our fixed income platform www.fixedincome.global. Thank you. Have a wonderful time ahead.